Clay. Thanks for joining us.
You're more than welcome, Mark. It's always good to see you.
Absolutely. It's here in sunny Sydney. Beautiful day outside too, I might add. So harbour in the background. We're talking about cloud computing today, Clay, which is a massive growth industry. Can you give us an example, just something that people can latch onto about what cloud computing actually is?
Yeah, absolutely. So I think a simple shortcut way of understanding cloud computing is just to remember what we're really talking about here is a location change. So most of us grew up in a desktop computing world. We had a computer sitting in front of us, and all of the computing power and software that we were using was sitting on a desk in front of us. The difference with cloud computing, again, is this location. We've simply moved the computing power and software to a remote location. So it's now sitting in a data center somewhere, and now we are simply communicating with that computing power and software via the internet.
Right.
So it's really just a location change.
Yeah. And some of the most simple examples would be things like Dropbox, Office 365, just as an example. So rather than having email on your server, you've now got email in Microsoft servers.
Exactly. Look, I always think a nice common example that most people at home would be using, and it conceptually brings it back, is something like Netflix, right?
Yes.
Netflix is cloud computing. Think about it. We used to keep DVDs and VHS cassette tapes in our home.
Yep.
We don't do it anymore.
No, absolutely.
Netflix, they've put all of those movies and TV shows, they now sit in a data center somewhere.
Yep.
We have our TV that's connected to the internet.
Yep.
And then we use the very simple menu software to say, all right, please send me that data and content and play it for me. So if you've used Netflix, you've used cloud computing.
Yep. That's an excellent example. We were talking about jargon before, and this segment is loaded of jargon.
It's known for it.
And it strikes me there's three key segments of the cloud computing market. Are you able to just briefly talk us through those and maybe give us an example of... Anyway, I'll let you talk us through.
Sure. So the common, you'll hear some acronyms. So it's infrastructure as a service, which is IaaS. Then there's platform as a service, and there's finally software as a service. So what are these? And again, to bring it back to the core, what these three things are, they're just different ways to purchase cloud computing services. And the difference is really how much of the process you as the purchaser want to manage and operate yourself. But let's go through it. So the first is infrastructure as a service. And as the name would imply, infrastructure, here you're really just renting bare computing power. So you're going in and saying, I want to rent access to servers, databases, servers, networking, and storage. Then you as the operator, so you'll rent that computing power, but you will choose what operating system you install, what databases you install, and what software you will install on top of that.
Right.
So this infrastructure as a service is where you are still doing a lot of customization yourself, and you're still managing a lot of that software and kind of operating systems. Platform as a service is similar with the twist. So again, you are renting the infrastructure, but now the platform as a service operator, he has chosen what operating systems and databases to install on that computing power for you, and he will manage that. So with platform as a service, what you're really doing is you're going and renting a fixed and ready operating environment for you to go and code software onto, or for you to run software onto.
So, as opposed to infrastructure as a service, is really just renting the hardware.
Exactly. So again, you're doing less customization with platform as a service, and you're managing less of the process. The final aspect is software as a service, and this is quite different. With software as a service, you're really just renting a software application. For all intents and purposes, you're not managing anything. You're just saying, I want to rent access to that software, and I want it to run parts of my business, or I want to use it for my personal use.
So Netflix would be an example of software as a service. Adobe Photographic would be another example.
Microsoft 365, if anyone's got an Apple iCloud account, same kind of thing.
I do, yes. And so just going back to the infrastructure and platform as a service for a second, there's in the developed ex-China, there are only a few key competitors. Are you able to talk us, who are they, and it'll surprise many people who one of them is?
So in the West, what we've seen, I would just call them cloud database providers. The big players are really Amazon Web Services, Microsoft Azure, and then the third is Google Cloud. And what we've seen...
And the biggest of those is Amazon, by a big margin.
By a decent margin. So Amazon was first to this market, but we're seeing that Microsoft Azure and Google Cloud are catching up quite quickly. So those big three are growing quite fast, but they're really leaving the tail behind. And there's some quite large scale benefits that accrue to the biggest players in this industry. So we do think this market looks like it's consolidating down to a cozy oligopoly. We probably think that continues.
And so why would companies use them? And let's say take some of the big banks in Australia, for example. Why would they use services from Amazon or Google or Microsoft rather than develop their own?
So basically there's a cost advantage around outsourcing or outsourcing the hardware and some of the management of those core, the operating system, the databases, the middleware to these big third parties. And we can think about that in different ways. So the first is basically if you've got a business, the amount of computer, server resources and the like, you need an amount that matches your peak load. But your peak load may only be a few times in the year, and the rest of the time your normal base load may be 30% of that. So you need to maintain a huge amount of latent space or latent resources just to meet those peaks. If you cannot do that and then rent that space flexibly and say, all right, well, we know what our peaks are, so for those periods we will rent more power, you can reduce your costs that way. Also, in terms of consolidating the service, you're outsourcing the technical staff to these big players. And there's some stats, so you see that for an enterprise generally in terms of you need one member of staff for every 100 services you operate internally. We're seeing the efficiency of these cloud operators because they're operating at such scale, they can afford the latest automation techniques. They're running at one staff member for every 1,000 services.
So that's a 10x. A tenfold efficiency.
So there's multiple reasons why the outsourcing makes sense, and most of it comes down to a cost benefit.
And the other aspect that people worry about with cloud computing revolves around security and data breaches. We recently had National Australia Bank executive from the IT department come out and say it's actually more secure in the Microsoft cloud than what we can make it. What's your view of the security from particularly those three big players? Look,
so there's different studies that have been done into this, but there's some stats against studies because again these cloud operators, they can invest in cutting edge network security. They are doing this right. They've got the money to invest, and it is a key portion of their service and of their business. So, the stats kind of pointing to that basically you are 65% less likely to have a network or attack or a security breach via using some of these cloud services. So there seems to be some truth to that. And again, that is another one of the selling propositions.
Okay. And can you give us an idea of the size of this? And we're talking the infrastructure side of it just at the moment. What's the size of the market in the West for that? And by extension, what's the potential growth over the next period of time?
Okay. So if we just simply look at infrastructure as a service and platform as a service, in terms of a total revenue base, that's roughly $50 billion today.
$50 billion US.
$50 billion US, and that's growing at a rate of roughly 25% per annum. So that's some pretty big annual growth rates in terms of pure dollars. We're talking about $12 billion a year. So $50 billion, and you kind of go, well, what is the addressable market? So if you look at total enterprise, global enterprise IT spend that's relevant for kind of that hardware and database side, it's probably roughly around $800 billion today.
Okay.
So
we're talking of potential from 50 to 800.
Well, you'll probably never get to 800, but what you can say is, look, we still have less than 10% market share of that entire market. And I think it's just safe to say that there's a decent amount of growth to come, very simply. Where it will cap out, it's hard to, but can you see this market doubling or tripling over the next 5 to 10 years? Absolutely.
Yeah. And so what advice is the wrong word, but what tips would you give investors for how they should think about this space, given that there's at least two segments? There's the software side and then there's the infrastructure side.
Yeah. And this is a very important point, which we always come back to. Just because a sector is growing fast and is too exciting, that doesn't immediately make it a good investment. And history is littered with examples of this. Investing in Japanese real estate during the 80s and tech stocks during the late 90s, they were both exciting and growing fast, but you had a pretty poor investment outcome. And that's because you need to always keep asking yourself, when I'm investing today, what am I paying for that opportunity, and also what are the expectations that are baked in around those stocks. And the cloud computing space from an investment perspective is quite interesting, because there are some portions of that space that we think, where you're seeing almost bubble-like valuations.
And is that mainly on the software side?
That is mainly on the software side. But conversely, on the hardware side, where you're seeing valuations that are ranging from reasonable to, we think, downright cheap, and we're very excited about those sectors. So from, in terms of advising investors around investing, we would say, particularly on the software side, we would call out that there's reasons for caution, and that comes down to, one, the valuations are incredible. There's a huge amount of hype around these software stocks. To give you an anecdote, many of these businesses are only recently listed on stock markets.
And they're valued on price to sales rather than price to earnings.
Yeah, and that's probably worth mentioning as well. So why is that? So there's a land grab mentality going on at the moment. So companies are trying to secure customers very fast, and the way they're doing that is spending a huge amount of money on sales and marketing. So most of these companies are losing money today. That makes it difficult. That makes it a far more complex analytical task to assess the quality of these businesses, because you're making a lot of assumptions around, well, what is the actual underlying profitability of these businesses in a steady state? So that's a tough thing for, I would say, an individual investor to do.
Yeah. And so you mentioned there's some segments that are very cheap, and we know some of how you're playing this space. Are you able just to elaborate on say, one segment of the cloud computing space that's really interesting and really cheap, which I think is the chip makers? Yeah. Look,
and that's what we're very excited about. And here we've got this dichotomy. So we have the software as a service companies, or the stocks. They're trading on 20 to 25 times price to sales.
Not price to earnings, price to sales, which is massive.
It's very different. So there's immense enthusiasm, and there's immense belief that this is going to happen. And we don't disagree that this is going to happen. But on the other hand, you have the hardware and chip makers who are providing the underlying hardware that powers these databases. So if if cloud computing is going to take off and grow for many, many years, we are going to need a lot more hardware. But despite that, many of the hardware companies, you can buy them on single-digit PEs, or in case of Intel, on 10 or 11 times earnings. And that's a very interesting differential and starting point. So we've been particularly interested in the hardware space. Here we have invested in companies like Samsung, Micron and Intel. Samsung and Micron, they make memory. So they make DRAM and they make flash memory. So again, coming back to with computing power, we need a lot of memory to basically process data quickly, and we need a lot of storage to store all of that data that we're using. You know, think back to your, I would hate to see your Apple cloud storage size, Mark. And these companies are basically making those two key components to the data centers. There are 3 competitors in that market globally. Underlying demand for this hardware is growing at 20% per annum when we're talking about DRAM, and up to 50% per annum when we're talking about flash memory. Similar with Intel. Intel basically have over 90% share of the CPUs that power these data centers. They have an oligopoly with AMD, and the future looks quite bright. We're fairly certain there's going to be a lot of data center capex happening going forward. So that's one of the major areas that we've chosen, or major ways that we've chosen to get exposure to this investment theme, as it were. And today it's the largest. That group of semiconductor companies is the largest position in the international fund today in terms of sector exposure.
And single digit or 10 times earnings, not 10 times sales, sounds very cheap to me. Or in other words, if cloud computing is a gold rush, you're really investing in the picks and shovels rather than the actual gold mine itself. So,
exactly, I couldn't have put it better myself.
It's not bad without any rehearsal too, Clay. Thank you very much for your insights. That's outstanding information for investors, so thank you.
You're more than welcome. Thanks, Mark.